Hey everyone, in this video I wanted to bring you one dividend stock that's down 40% off its highs that you might regret not buying on the dip. But before I tell you what this dividend stock is, I'm going to show you some of its metrics including its dividend yield, and then finally towards the end of the video I will reveal what that dividend stock is. So let's get started with the dividend yield. Of course, one of the more important things when you're looking at a dividend stock. And this stock boasts a dividend yield of 3.94%, almost equivalent to what you can get with a 10-year government bond. But the difference with the dividend stock is you're also getting the chance that the stock price will increase or decrease over this 10-year time period compared with the government bond, where you're not exposed to fluctuating prices if you're going to hold throughout the entire 10-year period. So that's the difference there. You're getting a similar yield with the 10-year government bond, but you're also getting the chance that the stock price will increase. That's why it's important to look at some of these other metrics I'm going to show you here. Starting with the revenue. Of course, this company you could see here over the last 10 years, its revenue was growing nicely before the pandemic disrupted its operations and revenue collapsed, but now it's recovering stronger than before the outbreak. Its revenue of 165 billion in its most recent trailing 12-month period is significantly, well, I shouldn't say significant, but it's better than where it was before the outbreak. And the market conditions, the supply chain shortages are all working in this company's favor right now. It remains to be seen how much longer it can benefit from this trend, but it doesn't look like it's going to end in 2023. It looks like this company is going to benefit from these shortages and allows it to sell its products at higher prices at least over the next 6 months. And what's that's done for the company's operating profit margin, which I have pulled up here. After it fell during the pandemic, its operating profit margin has moved up very nicely, up to 7.38%. And this is a result of those supply chain shortages I talked about earlier, which is allowing the company to sell its products at higher prices, withhold incentives, not needing to do promotion, not needing to advertise as much to sell its products, and that's all working in its favor. And it looks like I mentioned earlier, this will persist for at least a little while longer. And finally, the last reason I will highlight why you might regret not buying this dividend stock on the dip here is because of its relatively cheap valuation. This stock is trading at a forward price to earnings of just 8.77. That's near the lower end of where it's traded at over the last 18 months. And if you compare it to some of its newer rivals, it's a relative bargain. So, what's the name of this dividend stock? This is Ford Motor Company, ticker symbol F. And like I mentioned earlier, if you look at Ford's newer rivals like Tesla, like Rivian, like Lucid, and others that are solely EV focused, those stocks are way more expensive than Ford, while Ford has plans to really ramp up electric vehicle production over the next few years to become one of the leaders in electric vehicles. And this surge in profitability over the last 2 years is giving it billions of dollars of cash flow that it's now investing in the transition. So things are really working in its favor, and that transition is looks like it's going to be smoother than it was expected for Ford Motor Company. All right, for all those reasons, I think you might regret not buying Ford stock on this dip here. But that's all I've got for this video. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.